if I just read the news, if I just read the Wall Street Journal, CNN, whatever, I would just go hide at my house and lock the doors and come out in 6 months.
This is Durable Value. Get investing and business insights from industry experts and successful entrepreneurs every week. Like and subscribe now.
So today, Joe, over the last, call it 60, 90 days, a lot of the world, the market has changed. And it'd be great to spend a little bit of time reflecting on uncertainty, fear, resiliency. When the market shifts and there's that uncertainty, what does that mean?
Yeah.
And how do we navigate that?
These have been really interesting times. We have gone from getting interest rates on acquisitions in the mid 3s to now in the mid 5s and pushing towards the 6s. That has challenged us to adjust cap rates and exit cap rates, and has especially challenged us to be very diligent in pricing. There's a big part of this business is making your money going in and not overpaying.
Yeah.
And so we've some of the deals that were on the board we've scrapped. All of the deals we have gone back and challenged for better pricing. Yeah. And it has been this last couple months has been a unique period of grinding in this business. And
yeah, it reminds me to some degree, we started the firm in December of 2008, right at the cusp of the Great Depression or Great Recession or global financial crisis, whatever you want to call it. I think the easiest way to sum that up is the deepest real estate recession since the Great Depression.
December of 2008 was about the time through 11, or I think 11 was officially the bottom of that recession, but from 2008 to 13, it was a very challenging time in commercial real estate. I remember, a lot of 6-month concessions on office tenants and those sorts of things. And as we were starting the business then, we had a brokerage piece to what we were doing, and we were selling foreclosures. I remember notifying business owners that their building was going to be sold, and I was their first point of contact between them and the bank. And those were...
And going into assets that had been neglected, or, the owner locked the door and walked away.
Yeah. They were ghost towns. You'd go into a dentist office and it's like they just left. They were weird times, but those were really special times, and that we had to be really creative in our deal making. Timelines were really critical. Underwriting buyers and their capital was very critical. It very much informed the way we built this firm. We built the firm in not with a distressed mindset, but with a mindset of what could be and what distress looks like.
Well, and so much of what we saw was a case of the debt situation, because debt is what ultimately makes a owner of a property make bad choices. Or rather be forced to make bad choices. We saw so many situations where, whether an owner wanted to or not, there were decisions being made about that property that you step back and say, this is not in the best interest of that property. This is not how you attain the highest value, but because of the lender situation, this is what's happening.
Those were interesting times, though, in that interest rates stayed very low. And you had high tenant vacancy, so especially on office and industrial, especially office, high levels of vacancy, and also very, very low prices. Today, we've got a different animal. We've got debt moving, we've got cap rates moving, but we have we have very low vacancy and rents that are still growing by the month.
And very supply-constrained markets across product types, too. And ultimately, I think the word that we're looking for is uncertainty.
Yeah.
It's a different type of uncertainty, but there are moving parts and moving pieces to how this unfolds over the next 6, 12, 24 months. And those are the times that people could take kind of I'm just going to sit on my hands and see what happens.
Yeah.
But there are also the times that, those who are close to the ground, that know the business, that know their markets, you can arbitrage and take advantage of opportunities.
The question is, are you a macro player, are you a micro player, or are you both? I mean, the first answer is we have to take the macro into context. The second answer is, we are professionals, and for most of the assets we buy them from wealthy families or more local players, people that aren't working as hard, as often as we are. So for every deal we do, there's 10 or 15 other offers that went in that we didn't do. And every property sells. I'd like to think that we're getting the best of that bunch. And with every deal we do, we've underwritten a value add to it that we can affect immediately, regardless of the market. So if you're just saying like, all right, the market's here, it's going to go to here, and then it's going to go to here. I want to be like a stock. Like I want to be on the right side of that stock movement. Well, okay, that makes sense. But everything we buy, while we must take into context the curve, we're coming in the middle of the wave, and we're working like heck to build value. So number one, I think we're buying better than virtually everyone in our markets by nature of the size and scope of our business and our experience. And number two, we're adding value more efficiently and better than I think anyone else in our markets. So
yeah, and ultimately, with a value add strategy, that should be able to be deployed in any market cycle. Obviously, when the market's good, we all get paid more for the work we do because there's momentum behind and that sort of thing. But at the end of the day, the description of the non-sophisticated or unprofessional seller selling to a professional owner, that happens in any market cycle. There's opportunity in any market cycle.
Sure is easier when there's not fear running rampant. When capital is moving and everyone sees the market go up month by month, it's easy to pick your best bet. Offer on 15, offer on 20, get one. But hey, the market's going up month by month. Like it's great, but you're still riding that wave. And so when the wave recedes, the question is: are you going to shrink back in fear, or are you going to be more selective, dig harder, continue to grind for value? And that's what we're doing. We're in the business of, frankly, buying and selling in all markets at the right time, when we've added the right amount of value and we think it's the right time in the market. But we will continue to buy this year, and we will grind for value, and we've been grinding.
Well, so speak a little bit to that. The word that comes to mind for me is resiliency, and that's in the face of fear or uncertainty, how we respond to that. I'd love to hear a little bit about what resiliency looks like for us today.
Well, it's our almost 15th year in business, and building a business from scratch takes a tremendous amount of resiliency and courage and ability to create and sustain. And I think that translates, building a business, currently we're 53 people, translates well into investing. The ability to show up every day and do the task in front of you and sometimes it's just don't think, just work. And you can't control the outcome, you can control your actions. So I can offer today, I can push.
And you can control your decisions.
You can control your decisions.
Yeah.
So on the offers that we have in, every single time I'm pushing for more value. I'm even on a $20 million or $15 million offer to push harder for that extra few $100,000 at the end. You fought for that first increment, maybe you fought for a second increment. I think a hallmark of these times is you fight for a third increment. And if I'm not pushing to save that last few $100,000, which is a pretty small percentage of the deal, then we haven't done our jobs. And those translate to basis points in IRR. And so we are underwriting to higher IRRs these days by probably 4 points, 3 points. And so far we've been finding it.
What about offers and deal pipeline?
Yeah,
in this environment,
it's different. In there's the saying that in declining markets, sellers are the last to notice and buyers are the first to notice. So buyers are like, hey, it's a different world. And sellers are like, no, it's not. Nope, it's the same world. and then when the market's going the other way, buyers are like, I want last year's price. And the seller's like, whoa. So
market's changed.
it goes both ways. But we're currently in a point where many sellers are unaware that the world has changed.
Or acting unaware.
Right. And if they don't need to sell and they think they have some time, then that's a fine approach. But on the buy side, it's our job to sift through dozens and dozens of buyers to find those that are ready to move on and willing to pay today's price, not January's price.
I mean, arguably,
sell it today's price.
Arguably, this is the first time in a decade that, as the buyer, we would rather have today's price than 6 month ago price. And
the
for
trick is what's 6 months from now's price.
I know, exactly. But the last decade has been, I'll take it today because tomorrow it's going to be, a higher price. And now, it's shifting. But it's a function of how much are we market timers versus are we focused on factoring in the variables and making our best decision at that moment. Because market timers would say, I'm sitting on the sideline, wait till I see that bottom, till I feel like it's rested right there. And usually what that means is that it's already started to go back up before you're re-entering the market. Our job is to factor in all inputs right now, and in real time, the amount of adjustments that we have made in our underwriting, our offers, our exit cap rates, everything over the last 4 months has been substantially different than what we had 12 months ago. Because the world has changed.
What's interesting is right in this moment, in July of 2022, there's a fair amount of groups that are saying, wait. And they're saying, I'm going to pause for 3-4 months and let this next round of interest rate increases happen, let something happen, get a better feel for things. On the one hand, I understand. On the one hand, we're doing that to some degree. On the other hand, there is this breathless moment right now where there's very little competition in the market. And for the right seller and us as the right buyer, there are some deals on the table right now that are absolutely worth doing and should be done. And hey, this is what we do. So we are here to hunt for those deals.
Yeah, and it may mean sifting through more deals to get there, but I agree. It's a supply and demand thing, and right now we have a moment in time where there's a bit of a pause, and if we can still find that seller that is motivated to do something right now, then we can find value.
We're working on a portfolio that was on market. It's now off market with a large national seller, normally someone we wouldn't buy from. But in this change, we've been able to retrade it hard, really, really hard, and also parse off the pieces of the portfolio that we really want. Mm-hmm. Two things we could have never done a few months ago when the market was good. Absolutely could not have done. And right in this moment, this breathless moment, I love the deal that we're working on. And we don't have it yet, and I'm not going to say, but these are the deals that need to be done right now and should be done. And if we took 4 months off and sat on the beach somewhere, we'd miss on these deals.
Yeah, and I think our history of navigating through all the distress of the Great Recession, the foreclosures, it gave us perhaps a higher tolerance for being in the presence of factors that could cause fear, right?
Yeah.
It gave us a comfort level. It's not like, oh my gosh, I've never seen this before.
Yeah.
It isn't like, oh, this is just like what happened last time and it's going to happen this way. We all know that the world does not unfold in exactly the same way. There's that, famous phrase that it's, it doesn't repeat exactly the same.
It rhymes.
But it rhymes.
Yeah.
It rhymes.
But which way is it going to rhyme?
Yeah.
I often play the opposite game in my head. Like, all right, I think it's going to do this. What if it does exactly the opposite? And like, how would that happen? And so often that is what happens. So the crowd may be planning for this scenario, and it's going to go that way. So I sort of like to bet the opposite way, but know what our outcome is on both sides.
Yeah,
but if you're thinking in a contrarian way, usually you have an advantage over the whatever the herd's doing.
Yeah, it's charging towards danger or contrarian view with an eye toward the exit. It's always knowing what that kind of worst case is versus the base case.
We're in a unique spot, though. Our firm's in a unique spot because if I just read the news, if I just read the Wall Street Journal, CNN, whatever, I would just go hide at my house and lock the doors and come out in 6 months. Like, based on the headlines, it's a scary world out there. But our job's different. We are where real estate investing in our markets touches the ground. Like, this is the tarmac. We are at the tarmac. Like, I and our team and you are at the actual buildings talking to the actual tenants. And the capital and the investors that rely on us are a step or two removed from that. We often do property tours and that sort of thing, but we're the ones that are like offer. And we're like sampling all the time. We're sampling like, what do you think of that? What do you think of that? What do you think of that? Whoa. And then we see one and it's like, that is better than the 7 we just offered on. That price per square foot, that price per door, the rents relative to market,
the
that
sub-market,
seller profile, that sub-market. Like, when you're like sample, you can get that best one. And so it's really important that we keep sampling and we keep making decisions that are appropriate, because our job is not to make decisions as our investors would, 2 or 3 steps removed. They hired us for a reason. We're on the ground, like we're there, and it's our job to make ground level decisions. And I think we're an absolutely great firm at doing that.
Yeah, and I think obviously 6 months from now, a lot of this will have unfolded or settled. But I think at the end of the day, in every environment, being able to factor in all of the inputs in that environment and make the best investment decisions then is a critical feature of a durable investor.
Thank you for listening to Durable Value, an investors podcast, where we demystify commercial real estate with safe, sound investment strategies to help you balance your portfolio. If you enjoyed this podcast, be sure to rate it on iTunes or wherever you get your podcasts. To learn more, visit GraceadaPartners.com, where you'll find more information, investors' tools, case studies, and more. This podcast is hosted by Joe Muratori and Ryan Suela. It's produced, edited, and mixed by Melodic, with intro music by Ian Post. Thanks again for listening, and we'll see you next time.